Hi everyone, good afternoon and welcome to the live stream today. Very much excited for having you on the live stream. We are continuing with our IFRS masterclass with our focus today basically on looking at IAS 16 and practicing some questions on IAS 16 and then touching as well on other accounting standards as we build our knowledge for the ICAG May 2021 examination. And I see some of you already joining the stream. Welcome to the live stream. This is the part 3 of our IFRS masterclass. In case you missed the part 1 and yesterday's session part 2, I'm going to leave these in the description to this video and you can watch it later on as well in relation to that. So we are going to get straight up into it where I'll continue with the discussion on IFRS IAS 16, and then also provide you with some assistance in whatever it is that you need to understand. I see some of you guys joining the stream. Welcome to the live stream. Patrick Edu, I see you in a comment box. Smash the like button on the video when you join. Share the video. Let us reach as many students as possible. That way, together, we can assist many students across the country so that we can together make the world a better place. So smash the like button, share the video, comment in the chat box. Let me know any questions that you have for me or things that you would want me to share my thoughts on real quick as we continue with our discussion. So like we started yesterday with IAS 16, we saw a couple of issues about IAS 16. We discussed the issues in relation to what are the objectives of IAS 16. But before that, we made mention of the fact that when it comes to tangible non-current assets, there are two things we need to understand. We need to understand the fact that we have what we call owner-occupied tangible non-current assets and then non-owner occupied tangible non-current assets. We said that the owner-occupied tangible non-current assets are the ones that the business uses in the generation of its revenues or for day-to-day running. It could be for administrative purposes, for production purposes, or being used as a showroom. Then we made mention of the fact that there are other assets that a business may have that it is not using for day-to-day running, but instead it is holding on it for capital appreciation or for lease purposes. And we made mention of the fact that if these assets are leased under operating lease, then we can account for it in accordance with IAS 40 investment property. So we spent time to look at the various issues we need to understand about initial recognition of property, plant, and equipment. We spoke about the issue in relation to what should be included in the initial cost. We discussed the recognition criteria. We spoke about the subsequent measurement of properties, plant, and equipment. And then we spent some time to also look at the issue in relation to the various depreciation methods that you need to know about. Now, when it comes to the depreciation methods, I made mention of 3 depreciation methods. We spoke about the straight line method, the reducing balance method, as well as the sum of year digits method in relation to that. So we discussed these as ways through which we can depreciate assets for an organization in that case. So now we want to turn our attention to look at the various other issues that we need to go into. And yesterday we got to the depreciation method. So let me know if there are any questions you have for me. Please put it in the chat box. I would want to hear from you. Ayayi Oluwatobi, I see you in the chat box. Welcome to the live stream. Jane Damaxine, hello Jane. I hope you are doing well. Please smash the like button on the video. Let's get more engagement on the video. And also remember to share the video. Let's reach as many students as possible as we continue with our IFRS masterclass, focusing on IAS 16 and looking at some questions as well today. So after we deal with the issue in relation to IAS 16, after we deal with the issues in relation to the methods of depreciation, remember yesterday I told you that IAS 16 states that at least assets should be revalued once every year. In other words, irrespective of the method of depreciation we are using, assets must be revalued at least once a year. It is for this reason why the concept of revaluation is critical for us to look at. So let's look at revaluation of assets. So revaluation of assets. Now, when it comes to revaluation of assets, this is one of the critical areas that you must make sure that you understand very well. And it's a bit technical, but I'm going to make it really simple for you so that you'll be able to understand it and know how to really go around it very well in that case. You ready about that? Okay, so let's go. Now, so when we revalue assets, two things can happen. We can have upward revaluation and then downward revaluation. So two things can happen when it comes to revaluation of assets: upward revaluation and then what? Downward revaluation. Now, when we say upward revaluation, what does that mean? So we're going to spend some time a little bit to look at the upward revaluation of assets. So let's look at that real quick. Now, upward revaluation of assets is where an entity revalued an asset where the fair value of the asset is greater than the carrying amount or the recoverable amount. Sorry, the fair value of the asset is greater than the carrying amount or the carrying value of the asset. What does that mean? It means that these results into what is called revaluation surplus or revaluation gain. Revaluation surplus or revaluation gain, depending on whichever area you are standing, it's still going to be correct. So when your fair value, okay, is greater than the carrying value of the assets, then it will result into what? A revaluation surplus or a revaluation gain. Now, anytime there is a revaluation surplus or revaluation gain, the question we ask ourselves is, okay, what is the double entry? So the double entry for this is going to be that we will debit property, plant, and equipment with a revaluation surplus or revaluation gain, and then we will credit the issue in relation to revaluation reserves account, RR, okay? Revaluation reserves or revaluation surplus account. Remember, it will also be credited to the other comprehensive income. Now, stay with me carefully. This is where the journey begins to become interesting. So stay with me carefully. So what are we saying? With upward revaluation, it is where the fair value of the assets is greater than the carrying value of the assets. And this results into what is called the revaluation surplus or the revaluation gain. Now, the double entry for this revaluation surplus is going to be that we debit property, plant, and equipment, and then we credit revaluation reserves and the other comprehensive income. That is, if you are preparing the statement of profit or loss and other comprehensive income, then any revaluation surplus or revaluation gain that is obtained during the year will be credited or brought under the other comprehensive income as an addition to the profit for the year in obtaining the total comprehensive income for the year. So that is the idea about the double entry. But there are two things that happens anytime there is this issue about upward revaluation or when we revalue assets. There are times when entities would have to make an annual transfer. I'm going to explain that in a moment. And then there could be deferred tax resulting from the revaluation. Deferred tax. Now, I'm not going to be talking about the deferred tax aspect of the revaluation today or in this on this discussion, because I'll talk about the deferred tax aspect of revaluation when we are looking at IAS 12 later on in the series. Okay, when we are looking at IAS 12 later on in the series, I'll talk to you about this. But note that anytime an entity revalue assets, two things will come into our mind. That is the annual transfer as well as what? The deferred tax on the assets that has been revalued in relation to that. But when we say annual transfer, what are we talking about? So let's dive deeper a little bit to the annual transfer. The idea about the annual transfer is that IAS 16 states that depreciation should be calculated on the revalued amount. Stay with me carefully. Depreciation should be calculated on revalued amounts. Now, when an asset is revalued upward and depreciation is calculated on the revalued amount, what it means is that the entity will be charging more depreciation than it should have charged, hence reducing the profits that is attributable to the equity shareholders of the company. Let's take that again. When an entity revalues its assets upward, The standard states that depreciation should be charged on the revalued amount. When that happens, it means more depreciation will be charged than it should have been charged. Hence, it results into a revaluation, a reduction in the profit, which is attributable to equity shareholders. So in order to compensate the equity shareholders for a reduction in their profit due to the excess depreciation charge as a result of the revaluation of the assets, IAS 16 allows that entities can make what is called annual transfer, meaning that the revaluation surplus will be transferred from the revaluation surplus account, a portion, to the retained earnings account to compensate the shareholders for that particular item that is being talked about in that case. So let's go through it for you to really get the understanding of what we're talking about. So this is what I mean. Let's say that hypothetically, the carrying value of our asset is $20,000. Stay with me carefully on this. And then let's say that the fair value of this asset, it has been revalued. So the fair value of the asset is now $25,000. Now, after the revaluation, let's say that the remaining useful life of the asset still remains the same, right? So the remaining economic useful life of the asset, let's say it's still 5 years. Now, I want you to stay with me carefully here. And we are assuming that the revaluation was done at the beginning of the year or probably during the year. I will clarify this a little bit as we proceed in the discussion. So stay with me carefully. So the standard states that depreciation should be calculated on the revalued amount. So look at what is going on. For the year ended under consideration, the depreciation that is going to be charged will be the revalued amount, which is $25,000, divided by the remaining useful life of 5 years. And that is going to be what? 5,000. 5 is 25. 5,000. So this is the depreciation that will be charged for the current year under consideration. But is that what they should have charged? If they had not revalued the assets, the depreciation would have been based on the carrying amount, which is $20,000. So that would have been $20,000 divided by 5 years. And that would have been what? $4,000. So you realize that under this circumstance, what is happening? The entity is charging more depreciation than it should have charged. So that excess depreciation, which is the difference between what they are charging now and what they should have charged, which is the $1,000, is what we call the annual transfer. That one is what will be debited to the revaluation surplus account. Okay? So the 1,000 will be debited to the revaluation surplus account and credited to the retained earnings so that we can get more money in the retained earnings and sort of reverse the effect of the increased depreciation on the profits allocated that can be allocated to the equity shareholders of the organization. So this is what we mean by the annual transfer. The excess depreciation that is obtained as a result of the revaluation of assets. Okay, so either you do this, but there's another simple way that we could do the annual transfer. And another simple way that we could do the annual transfer is simply to look at the issue in relation to the revaluation surplus and divide that with the remaining useful life of the assets. So in this question, we are getting a revaluation surplus of 5,000, isn't it? Because the carrying amount is 20,000. The fair value is 25,000. So if you check the difference, the revaluation surplus is going to be an amount of what? 5,000. So when we divide that 5,000 over the remaining useful life of the assets, which is also 5, you realize that we will still obtain what? The 1,000 that we got there in that case. So that is how we deal with the annual transfer. Please note, it is not always that the annual transfer will be done. However, if the question is silent, then you do the annual transfer. Listen carefully. Listen and listen carefully. If the question is silent, you do the annual transfer. But sometimes in the question, the examiner could tell us that the entities does not make an annual transfer as a result of excess depreciation resulting from the revaluation of assets, or the company does not make transfer to reflect the revaluation surplus obtained from the revaluation of assets. So if the examiner states categorically that do not, or the company doesn't make transfer, you don't do it. But where the examiner doesn't state anything about it, but you ended up obtaining or realizing that there is an upward revaluation, then you would have to make this annual transfer in relation to that. So that is the idea about annual transfer. Comment in the chat box. Let me know if you have any questions about this discussion real quick for me, and then let's continue with the next thing. Right, so I see some comments coming in. Let me read them real quick. I see some comments coming in. Let me read them real quick. AA Basit with a thumbs up. Thank you very much. Ario, hello, good evening, Ario. Adam from Zimbabwe. Thank you for joining the stream, Adam. Always a pleasure coming your way. Benedicta Amankwa said hello. Hi, Benedicta. Aaron Martins with a thumbs up in the chat. Abraham Anise said hi. Hello, Abraham. Adolfo Stia said hi. I'm watching from Liberia. Awesome. Shout outs to Liberians. Hayford Osset said, I never understand this concept, though I have passed FR. Would be helpful in my CR. Thanks. Wow, that is awesome to hear. That is awesome to hear. All right, so comment in the chat box any questions you have for me, and I'll be able to provide you with some assistance in that case. Rose, I see you. You are welcome. Thank you, Nhyira. These refreshers are really helpful. That is awesome. But Egwam said, debit and credit, explain more. Okay, what I said was that the excess depreciation, okay, that we are obtaining, this 1,000 excess depreciation is a transfer we are making from the revaluation surplus account into the retained earnings. So you deduct it in the revaluation surplus account. Usually this thing will be done in the statement of changes in equity. So we will deduct the 1,000, the excess depreciation from the revaluation surplus or revaluation reserves, and then we will add it to the retained earnings. So that is why we say we debit revaluation surplus and then credit retained earnings, so that you'll be able to have a lot of profit available and you negate the effects of the excess depreciation on the profit that was available for the year, so shareholders can get more money in that case. But let me know if you understand the principle now. Comment in the chat box, let me know real quick. Please give us a thumbs up on the video when you join the stream. If you are getting some value from the video, smash the like button. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible and assist a lot of students across the country, across the continent, and most importantly, across the globe together in that case. So if you're getting some value, smash the like button for us. Remember to also share the video and let's reach many students. Now, we started our lectures for the May 2021 examination, the ICA. And for 390 Ghana cedis per paper, you can enroll and study under my mentorship. So you can check out the link pinned to the chat box or in the description and visit our website and enroll in a course today and be able to study under my mentorship. All right. So that is it as well there. Okay, Bart said, thanks, understood. That's awesome. Osman Ugariba said, join late. Having, okay, Osman, you have retracted your message, so you can come again and then I'll assist you in that case. So that is about the annual transfer. Now, remember, I said anytime there is revaluation, two things must be in your mind. There is a transfer aspect and also there is what? The deferred tax aspect. But I won't talk about the deferred tax aspect here. When we are doing IAS 12, we're going to be looking at the deferred tax aspect because this revaluation surplus would definitely result into deferred tax. And there is a way the deferred tax must be accounted for in the other comprehensive income and in the P&L account. And that is very, very critical. We're going to be looking at that later on as we continue with our discussion. So that is it about upward revaluation in that case. Upward revaluation in that case. Then let's come to the final part, and that is called downward revaluation. Downward revaluation. Now, with downward revaluation, there are two things here. We have what we call first-time downward revaluation and subsequent downward revaluation. I want you to stay with me carefully on this as I explain the concepts to you. You see, like I said, entities must revalue their assets at least once a year, okay? Entities are required to revalue their assets at least once a year. So let's say that we bought an asset in 20x5. Then 2 years later, 20x7, that is the first time we are revaluing the assets, okay? So if we revalue the asset for the first time like that, and there is a downward revaluation, it means that the fair value of the asset is greater than the carrying amount of the assets. In other words, the amount at which that asset can be exchanged between market participants in an arm's length transaction is less than the amount at which we are covering the asset or we are holding the asset. And off the bat, that can be referred to as impairment in assets. Usually, that could be referred to as impairment in assets, meaning that the asset has lost some value or the asset has suffered some impairment. So anytime our fair value is less than the carrying amount, when we are revaluing the asset, it results into what is called the revaluation loss. Revaluation loss. Or like I said, it could be called impairment. Now remember, this is the first time. Please take note of that. This is first time downward revaluation. First time. So when we value the assets or we revalue the asset for the first time, for the very first time, we realize that the fair value of the asset is less than the carrying value of the assets. So it results into a revaluation loss. In that case, what do? We don't think, we don't do anything. So we just write it off in the P&L account. So we debit the profit or loss account. That is the statement of profit or loss and other comprehensive income. We just debit it with that. And then we credit the property, plant, and equipment to reduce it. In other words, the impairment becomes expenses, isn't it? The revaluation loss becomes expenses. So it is written off in the P&L account. And then we credit the property, plant, and equipment account or deduct it from the property, plant, and equipment account in that case. So that is the idea about the issue in relation to the downward revaluation first time. But there is also another part of downward revaluation. You see, when we revalue the assets first, so let me take an illustration with you so that you get a concept well. Let me know. I hope you understand this concept we just explained here very, very well. So first time downward revaluation. We revalue the asset for the first time, and the fair value is less than the carrying value. So it results into what? Impairment or revaluation loss. For the first time revaluation like that, what do? We write it off ultimately. So you debit the P&L account and credit the PPP account in relation to that. Now, there is what I also call subsequent downward revaluation. And I wanted to stay with me carefully on that. Subsequent downward revaluation. Subsequent downward revaluation. Now, what do we mean by subsequent downward revaluation? What do we mean by that? Stay with me carefully on this. What I mean by subsequent revaluation is that we revalued the asset last year and it had an upward revaluation. But then in the subsequent year, when we did the revaluation again, now the asset has lost its value. So how do we account for it? So let me pull up a scenario. I'm just going to expand on the scenario we did earlier. So let's say my carrying value is $20,000. Then my fair value is $25,000. Okay, so this one results into a revaluation surplus of what? $5,000. Okay, so that's a revaluation surplus of $5,000. Now stay with me carefully here. And that was, let's say that is 20x5. Then the following year in 20x6, now the fair value of the assets is probably 10,000. Now stay with me carefully. So let's assume that in the 20x5, now the carrying value after depreciation was, let's say, 15,000. So stay with me carefully here. So we have 2 years. 20x5, the carrying value was 20,000. The fair value was 25,000. So it resulted into a revaluation surplus of what? 5,000. In 20x6, let's make this one 6. In 20x6, we are saying that this is an assumption, okay? We are saying that the fair value of the asset is what? $10,000, but the carrying value now at the end of 20x is what? 15,000. Now, we have done annual transfer. So we did an annual transfer in 2015. We did an annual transfer also in 2016. So now in our revaluation surplus account, we've debited it twice. Hence, we have only 3,000 left there. But now the asset is having a revaluation loss, LS, of how much? 5,000. When you compare the fair value and the carrying amount here, it's 5,000. So how do you account for this? This is where it becomes very interesting. So make sure you get it well. If you don't get it, put it in the chat box and I can take it again. So this revaluation loss of 5,000, how do we account for it? The standard states that since this is a subsequent downward revaluation, in other words, the asset that has lost value previously had a higher value. In other words, last year it was having a revaluation gain. So this year, if it is having a revaluation loss, don't just take it to the P&L account. The loss should be written off against any previously outstanding or recognized revaluation gain. Let's take that again. Subsequent revaluation loss must be written off against previously recognized revaluation gain. So the double entry for that is that you debit the revaluation surplus account with any loss you are getting, credit your PPE account. Any balancing figure is then taken to the P&L. Sounds good? Does it make sense? Let me know in the chat box if you have any questions. Let me know in the chat box if you understand. I see some of you guys joining. Now we are continuing with our IFRS masterclass, looking at IAS 16, the final aspect, revaluation of assets. And if you're getting some values, smash the like button for us so that we get more engagement on the video and we can reach more people in that. If you have not subscribed to the channel, also remember to subscribe to the channel. Hit the bell notification icon. That way, when I go live, you will be the first person to be notified and you will be able to join me on the live stream. So that is the double entry. So if I should put in these figures, you realize that our revaluation loss is 5,000. So that will be credited to the PPE account of the bet. But our revaluation surplus account has only 3,000 there. So we're going to write it off 3,000. So that the balancing figure 2,000 is what will go to the P&L account. This is what we mean by subsequent downward revaluation. Any questions? Subsequent downward revaluation. Any questions? Any questions? This is what we mean by subsequent downward revaluation. Any questions? Eric Boabin said, good evening, sir. Thanks for your assistance. Always a pleasure. Ebenezer Sai is saying, good, Nhyira. Good evening, Ebenezer. I hope you're doing well. Any questions, everybody good? Adolfo Stos said, please go over that for me. Okay, so let me go over that again for you. So subsequent downward revaluation. I'm starting over. I'm saying that this is where an asset is revalued downward, but had previously been revalued upward. An asset is being revalued downward, but had previously been revalued upward. So we are pulling a scenario up. We are just building it up from the previous slide that we did. That we mentioned that the carrying value, I'm giving an example, so that let's assume that the carrying value is $20,000. The fair value is $25,000. So you realize that the revaluation surplus is going to be $5,000. But the company does an annual transfer. So they will do the annual transfer for 20x5. Then they will do the transfer also for 20x6. So after that, you realize that the revaluation surplus account will have only 3,000 left. I'm using these figures just to make the point bring home. I'm assuming that the remaining life of the asset is also 5 years. Now in 20x6 at the end of the year, the carrying value is 15,000. Okay. And the fair value is now only 10,000. So you realize that in 20x6, the asset has suffered a loss of 5,000. But we are saying that even though it is a loss, you don't just go and write it off in the P&L account, because the standard states that any loss, revaluation loss, should be written off against previously recognized revaluation gain. Any subsequent revaluation loss should be written off against previously recognized revaluation gain. That is the idea. So you realize that with this scenario we are dealing with, the revaluation surplus account has 3,000 there. So the double entry is that we debit the revaluation surplus account, credit the PPE account. Any balancing figure left is going to the P&L account. That is the profit or loss account. So if I'm putting these figures up, our revaluation loss is 5,000. So we credit that to the PPE account. But our revaluation surplus account has only 3,000 there. So we write it off, 3,000. Then the balancing figure, which is the $2,000, will be debited to the P&L account. This is what we mean by subsequent downward revaluation. Does it make sense? Adolphus, let me know if you understand it now. And then Kayana Kwalampa, you also requested that I go over this. Let me know if you get it now. Fanika Kayode said, I have gained a lot from your lectures. God bless you. Amen. God bless you too. God bless you too. Let me know if you understand it now, Adolphus, and then Kayana. You guys requested that I go over it again. Let me know if it makes sense now to you guys. And I see some of you guys joining. Welcome to the live stream. We are continuing with our IFRS masterclass and looking at the IAS 16. We started yesterday with it. We are looking at the final aspect, revaluation of assets. Okay. So Adolfo said yes. Okay, that is awesome. That is awesome. That is awesome. So basically, when we talk about IAS 16, these are the things that you need to understand. When we talk about IAS 16, these are the things that you need to understand. So we've looked at what is the recognition criteria. We've looked at what constitutes the initial cost of the assets. We've discussed the subsequent measurements where we spoke about the cost module, the revaluation module. We've spoken about the methods of depreciation, the straight line method, the reducing balance method, and then the sum of year decades. Then we looked at the issue in relation to revaluation, and we've looked at upward revaluation and downward revaluation. Remember, in downward revaluation, we said that it should be either a first time downward revaluation or a subsequent downward revaluation. David Emirem said, thanks, Nhyira, love from Nigeria. You are welcome. Loves to you too. Ebenezer Sai said, Nhyira, can you please go over once again? Okay. Kayana said, understood. Thanks. God bless you. Ebenezer Sai said, please. Okay, so let me take it again for the last time. What we're saying here is that in 20x5, the carrying value of the asset was 20,000. Okay. And then the fair value is 25,000. So in 20x5, we are getting a revaluation surplus of $5,000. We are assuming that the remaining life of the asset is 5 years. So the company will make annual transfer for 20x5. In 20x6 at the end of the year, the fair value of those assets is just $10,000. But the carrying value, that is after the depreciation they've charged, it's now 15,000. And they will do annual transfer also for 20x5, for 20x6. So if you look at it, you realize that if you compare the fair value with the carrying value, you are getting a revaluation loss of what? $5,000. $5,000. That is the revaluation loss you are getting, $5,000. How do we account for this revaluation loss? The standard states that any subsequent loss should be written off against previously recognized gain. Any subsequent loss should be written off against previously recognized gain. So the double entry is debit the revaluation surplus account, credit the PPE account, and any balancing figure should go to the P&L account. Should go to the P&L account. So if we look back at our question here, the revaluation loss is $5,000. So we will credit the PPE with the $5,000. Then we will debit the revaluation loss with $3,000 because it is only that $3,000 that is available in the revaluation surplus account. So we write it off. Now, Ebeka 2,000, we will be left with 2,000. So that 2,000 we will be left with. Where do we take it? We take it to the profit or loss account. We take that to the profit or loss account. So that is the idea about that. Ebenezer Sai, let me know if it makes sense now to you. David Emirem said, can you give us a method to remember all the standards and how to study them in groups? Yes, I have discussed this. I discussed this in the part 1 on Monday. I discussed this. You can check the description of this video. I'm going to put the whole series in the description to this video, and you can look at how to study. That is the name, how to study accounting standards, I guess. How to study accounting standard. I did that on Monday, how you study the standard in group and how you study them together. So MRM, you can check that out on the channel later on after watching this, and you'll be able to get the understanding there. Ebenezer Sai, you good? Can we go? All right. So we're going to crunch some numbers. look at some questions real quick in relation to that. So let's look at some questions real quick. Now, remember that I told you in this series, I'll be solving some questions from, or the questions from the ICA question kit. Okay. So that's why I'll be solving the questions from. So let me share my screen with you to see the question that we want to solve. Okay, Ebenezer Sai said, yes, sir. All right, that's awesome. So let's stop sharing here. And let's go in here. Okay, so there you go. This is the question, is in the ICA question kit. For those of you who are having the ICA question bank or the question kit, this is in there. You can see it in there and be able to use it for your studies. I might not solve all the questions, but we will touch on a number of them in that case. Adjustments limited is always important for us to look at the requirements of the question. It says, explain the effect of these changes on the depreciation for the year ended 31st December 20x4. Remember, when you're dealing with the standards and you're dealing with financial reporting in general, the year ended is very, very critical. We cannot overemphasize that because that is very, very critical. So what will be the effect of these on the depreciation figure for the year ended 31st December 20x4? So you can take a screenshot of this question. I'm going to also post it on my Instagram page. So for those of you who follow me on Instagram, you'll be able to get access to it. So let's look at the first question there. Let's look at the first question there. So let's see. Okay, I see some comments coming in. Let me see if I can reply to these comments. Okay, I think my comments feed is not refreshing. So let's go. A lathe was purchased 6 years ago for 150,000 Ghana cedis. A lathe was purchased 6 years ago for 150,000 Ghana cedis. The plant had an estimated useful life of 12 years. The plant had an estimated useful life of 12 years. Residual value was nil. Depreciation is charged on the straight line basis. On 1st January 20x4, that is at the beginning of the year, okay? Remember, our year ended is 31st December 20x4. So on 1st January 20x4, that is at the beginning of the year, when the assets carrying amount is 75,000 Ghana cedis, the directors decided that the assets total useful life is only 10 years. The assets total useful life is only 10 years. Now, you got to be careful about what is going on here. This is where IAS 8 comes to town, accounting policies, changes in accounting estimates, and errors. Now, changes in the useful life of an asset in accordance with IAS 8 accounting policies, changes in accounting estimates and errors is a changes in accounting estimates. And if there is change in accounting estimate, it is applied prospectively. In other words, it will affect the current year and future results. Hence, in the A aspect of the question, which is the lathe that is bought, we won't go to the previous year and go and try to restate the retained earnings. Instead, we will just charge the depreciation for the year under consideration. But you got to pay attention to what is going on there. the asset was purchased 6 years ago, and it had a useful life of 12 years, which means that as at 1st January 20x4, the asset has been used for 6 years, so it has 6 years remaining. Okay, stay with me carefully. But now, the examiner is saying that on 1st January 20x4, which is the beginning of the year, when the carrying value of the asset was 75,000, the company decided that now the total useful life. Now, you're going to be careful about the English when you are reading. in financial reporting and in the exams very well. It says now the total economic useful life of the asset is just 10. So if the total is now 10 and we've done 6 already. So it means we'll be left with how many years? 4 years. Does it make sense? So right now, the current amount being 75,000 will be charged over 4 years. The current amount of 75,000 will be charged over 4 years. So the depreciation for the year ended 31st December 20x4, it's going to be 75,000 Ghana cedis divided by 4. And that is going to give us, where is my Casio calculator? It's here. Let's pick it up. And that's going to be 75,000 divided by 4, 1825. 1825. Think my screen. So 75,000. No, we're not dealing with dollars. So 75,000 over 4, and that's going to be 18. Still, I'm still writing dollars. Forgive me, okay? It's Ghana cedis. Can you imagine that? 18,750. So this is the depreciation for the year ended 31st December 2004, 20x4, 31st December 20x4. Does it make sense? So if we are looking for the carrying amount of the asset, they didn't ask us though, but if we are looking for the carrying amount of the late, as at 31st December 20x4, it's going to be 70,000 minus 18,750. And that's going to be, I'm tempted to write the dollars again. So 70,000. Okay, so answer minus 70,000. That's 51,250. So that is it. So I hope you got the explanation very well. So the lathe was bought 6 years ago. It had a useful life of 12 years. But now the entity has decided that after 6 years of operations, the asset's total life is now only 4 years, or only 10 years. So since they have done 6 years already, you are left with only 4. So in accordance with IAS 8, accounting policies, changes in accounting estimate, this is a change in accounting estimate. When we change the economic useful life of an asset, it is a change in accounting estimate. So it is done prospective application, not retrospective application. So we don't go to the retained earnings and try to adjust the retained earnings. No, it will just take effect from this year into the rest of the years in relation to that. So that is the answer to the A aspect of the question, late. Let me know in the comment box if you have any questions for me. Eduji Gakpo said, God bless you for the good works. Amen. God bless you too, Eduji Gakpo. So that is the answer to the question on late. Simple, straight to the point. Sounds good? So let's go. Let's look at the second one. Let's look at the second one. Ario said, where? Oh, no, it's 75,000, not 70,000. Sorry, I made an error. It's 75,000. Oh, really? So it's 75,000. I think when I was writing, I wrote 70,000, but it should be 75,000. Thank you, Ario. Let's correct that, the carrying value. Because 75,000 over 4 is the 18,250. 18,750. Okay, that is the depreciation. That's the depreciation. So the carrying value, it's now going to be 75,000 minus 18,750. So minus 75,000. So your carrying amount, we were not asked to do this, okay, but I'm just adding it, will be 56,250. So thank you for that correction. So that's an error. So your depreciation is still 18,750, but the carrying amount, I was using 70,000. I don't even know where I got that one from. So thank you very much, Ario. Okay, Bat also said that's an error. Yeah, that's an error. So thank you for the correction. So let's move on to the next question. Now, the next question states that a grinder was purchased on 1st January 20X1 for 100,000 Ghana cedis. The plant had an estimated life of 10 years and a residual value of nil. Depreciation is charged on the straight line basis. On 1st January 20X4, now be careful here, that will be how many years? So let's clean everything here. We are looking at the second one, grinder. So we buy the asset 20X1, we use it for X2, use it for X3. Then in X4, 1st January of X4, that means that we have used the asset 3 years. When the asset carrying amount was 70,000 Ghana cedis, the directors had decided that it would be more appropriate to depreciate this asset using the sum of years digit approach. The remaining useful life is unchanged. The remaining useful life is unchanged. So look at what is happening here. They've stated that the asset has a life of 10 years. Boom. But after using it for how many years? 3 years. Now remaining 7 years, they said they don't want to use the straight line method again, but they want to use the sum of year digits. The sum of year digits. So what are we interested in? The carrying amount is 70,000. That's what we are interested in. And then the year left is only 7 years. Now, remember, we are told that the remaining useful life is unchanged. The remaining useful life is unchanged. So if the remaining useful life is unchanged, how do we now account for this? So let me bring in my whiteboard and let's see how we can account for this. Now, the depreciation method has been changed. In the first example, what was done? The estimated useful life was modified. But now they are changing the depreciation method in relation to that. Now, since they are doing a depreciation method, what we have to do is that we need to look at the carrying amount and then apply the sum of year digits method in relation to that. But then you need to also understand that this is in accordance with IAS, how do we call it? 8, accounting policies, changes in accounting estimates. This is also a changes in accounting estimate. So we cannot go and do any retrospective application. We will do prospective application. However, a detailed disclosure would have to be made in the financial statements. We would have to make a detailed disclosure in the financial statement. So sum of year digits, how do we go about it for the year ended? Now, if you remember what we did yesterday, I told you that n out, n plus 1 over 2. So that is going to be 7 out, 7 plus 1 over 2. And that would be 8 times 7, 87 divided by 2. So that's going to be 28. So that's it, 28. So the total sum of year delegates is 28. I told you also that you could write it down if you want to have the time. So X4, X5, X6, X7, X8, X9, Y0. So that is 1, 2, 3, 4, 5, 6, 7. So you can write it down one after the other. Then you number 1, 2, 3, 4, 5, 6, 7. When you add these up, it should give you 28. Okay, so that is also another approach we can use to get our 28 there. So once you get a 28, the depreciation for the X4, which is what we are interested in, is going to be what? 7 over 28 times the carrying amount, which in the question was given to us as 70,000. And that will be 7 over 28 times 70,000. And that will be 19,000. I punched 25. That will be 17,500. So that will be the depreciation charge for the year under consideration. 17,500. Does it make sense? I hope you get a sum of year delegates. That is the idea about that. That is the idea about that. So remember, this one also, we don't go and do a retrospective application. We do prospective application, okay? We do prospective application in relation to that. So that is what you must understand in how this one is done. Now, we are interested in only 20x4. Assuming you want 20x5, it will be 6 over 28 times 70,000. If we should punch that and see, let's bring 6 to the numerator. And I'm getting 15,000. And remember, as the year goes by, the amount of depreciation will reduce, because that is the idea about the sum of year delegates. It's just like the reducing balance method, okay? So that will be the amount of depreciation that will be calculated, or that will be recognized in the statement of profit or loss for the year ended under consideration. Does it make sense? Everybody good? Let me know in the chat box. Okay, Lukman Jackman said, where from the 7? I think you didn't watch the lecture yesterday. That is the sum of year delegates rule. When you number 1 to 7, you turn it upside down, and then the 1 will be 7 over 28, the 2 will be 6 over 28, 3 will be 5 over 28, 4 will be 4 over 28, 5 will be 3 over 28, 6 will be 2 over 28, and then the 7 will be 1 over 28. So you reciprocate it, and then you get the amount of depreciation in that case. So look, man, that is the idea about the reducing, the sum of year delegates method. Does it make sense? Let me know if you get the rule now. You're good? So that is the idea about that. That is the idea about that. Then there is a C aspect, which is the last question we have there. Samuel Quason said, greetings, my boss. Yeah, greetings. Thanks for coming our way always. Always a pleasure, Samuel Quason. Okay, diploma student said, okay, sir. Okay, diploma student. Diploma student. Wow, nice YouTube name like that. Diploma student. All right. So that is it about that. So let's look at the last question there. Lookman said, not so well. Can you go over again? Okay, so this is what we are saying. Under the sum of year decades, the rule is that we write the years down, and that is 4, 5, 6, 7, 8, 9. Yesterday I discussed this very well, so maybe you can watch yesterday's lecture as well. So then you write the number of years. In this question, we have 7 years to go. So we number it 1, 2, 3, 4, 5, 6, 7 for the 7 years. Then you add it up to get your 28. To get the amount of depreciation chargeable for each year, you reciprocate starting from 7 from the 1. Okay, you reciprocate starting from 7 from the 1. So the depreciation amount for the first period, which is the 20x4, will now be 7 over 28 times the current value given to us in the question, 70,000. The second year, which is the 20x5, will be 6 over 28 times 70,000. The third year will be 5 over 28 times 70,000. That in that order. In that order. So you reciprocate, then the 7 becomes the first one, and then you bring it down. So because the idea is that at the end of the period, your amount of depreciation that you charge every year should be reducing. So realize that in X4 it was 7,500. In X5 it is now how do we call it? 15,000 in that case. So look, man, that is the explanation there. Let me know if it makes sense now and you understand it now. Okay, so let's look at a final question in relation to that. Let's look at a final question in relation to that. With a final question, so I'm gonna, okay, Lookman said, well understood, bless you too. So let's look at a final question. And probably I will leave the final question for you to try your hands on. What do you think? A company purchased a 50-year lease some years ago for 1 million Ghana cedis. This was being depreciated over its life on a straight line basis. So it means that they use straight line method 50 years. So annual depreciation, let's pick a red ink. Annual depreciation would have been what? 1 million Ghana cedis over 50 years. Okay? So if 1 million Ghana cedis over 50 years, we get the answer. So 1,000 over 50, and that's going to be 20,000 Ghana cedis every year. But look at what is going on. This was being depreciated. Yeah, that's what I just did. On 1st January 20x4, when the carrying amount was 480,000 and 24 years of the lease remaining, the asset is revalued to 1.5. This revised value is being incorporated into the account. So this is where revaluation comes to town. So right now, what are we interested in? 480,000 for the current value. We have 24 years remaining. And then there is what? A revaluation to 1.5. So off the bet, we are seeing a revaluation gain here. Okay? We are seeing a revaluation gain here. So we are interested in these three figures. 24 years remaining, 1.5 the fair value or the revalued amount, and then 480 for the current value in relation to that. So let's go into it, and then let's see how we put the pieces together. So if you are putting the pieces together, we have the current value to be 480,000. Then we have the the revalued amount. RA here is revalued amount. Let's bring that down a little bit. So revalued amount, and that is 1.5 million. So the balancing figure will be revaluation surplus, and that will be 1,500 minus 480. That will be 1,050,000. Okay, 1,050,000 in that case. Now remember, the revaluation was done at the beginning of the year, 1st January. So we'll charge depreciation for the year. So depreciation for the year, 31st December 20x4 is going to be 1 million. We'll use the revalued amount divided by 24 years. So 1.5 divided by 24, and that's 62,500. So you take it out, and then you get the carrying value as at the end of the year. So minus 1,500, you get 1,437,500. Are you getting the picture? Now, the examiner didn't talk about anything. So it means that this revaluation surplus, it will be taken to OCI. However, we need to do annual transfer. So you build that into the system. Annual transfer will be equal to the 1,050,000 divided by 24. 1,050,000 divided by 24. And that gives me 43,000. 1,050,000 divided by 24, 43,750. So this 43,750 oh, I'm missing something, eh? 1,580. Yeah, that's true. Thank you very much, Coyote. That should be 1,020,000. So it means my annual transfer will be wrong. Let's take that again. So 1,020,000 divided by 24, 42,500. Right. So that is the answer to the question. That is the answer to the question. So in the P&L accounts, we have the depreciation 62,500. In the OCI, the revaluation surplus of 1,020,000 will go there. Then in the statement of changes in equity, we will deduct 42,500 from the revaluation surplus and then add it to the retained earnings in relation to that. So this is the answer to the question, and that is how these are just freestyler. These are not tough IAS questions. Diploma student said, if you use straight line method, how will the B question be solved? If we're using straight line method, the B question, we would have solved it using the remaining life of 24 years. So was it 24? The plant was 10 years. It has been used 3 years already, remaining 7 years. So it would have been 70 over 10. Okay. Diploma students, if we're using straight line method, it would have been 70 over 10, 70 over 7, because now we have 7 years remaining. So it will be 70 over 7 to get the amount of depreciation to be charged for the year. So diploma students, that is the answer to your question. So, hey, that is it about it. This is where I'm going to be ending today on the live stream, and that is what IAS 16 is about. Now, we've not really exhausted everything about IAS 16, but what I want you to do is go out there, get some questions, solve some questions in that case. If you happen to enroll and study under my mentorship directly for the financial reporting examination, you'll get access to a lot of questions in our question kits. Then you'll be able to solve these questions, send them to me. I'll look at them for you and then assist you to have a better understanding as you prepare well for the examination. So go in there, Make sure you put in the work, make sure you put in the effort, and make sure that you do as much as you need to do in order for you to position yourself to pass the examination. And that is all I have for you today. So thank you very much for joining the live stream. It's always a pleasure coming your way. Thank you for the thumbs up on the videos. I really appreciated you guys with the thumbs up on the video. Thank you very much. Thank you for those of you who shared the video as well. Thank you very, very much. I'll be coming your way from Monday to Friday, 4:30 p.m. as we continue with the discussion. So tomorrow, we'll be touching on IAS 20, IAS 23, and you want to make a date with me and join me tomorrow at 4:30 p.m. In case you've not subscribed to the channel also, make sure you subscribe to the channel and stay connected. That way, when I go live, you will be notified and you'll be able to join the live stream in that case. Also, remember to follow me on Instagram, and because the meeting details and questions will be posted there, so you can get access to and prepare well for the exams in that case. So thank you very much, you guys. Always a pleasure coming your way. Patrick Edu, Ayayi, Jane, Basit, Ario, Adams, Benedict, Aaron, Abraham, Daniel, Adolphus, Hayford, Rose, Bat, Gariba, Osmanu, Kayode, David, Ebenezer Sai, Kiana, and all of you guys, thank you very much for joining the stream. So I'll be coming your way same time tomorrow, 4:30 p.m. as we continue with the discussion in that case. Fanika said, God bless you, sir. God bless you too. Gariba said, thank you too, sir. Always a pleasure. So take care of yourself, stay safe, and stay blessed. I'll see you same time tomorrow. Bye-bye.